Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Frey-Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to dive into 6 must-known facts about the Roth IRA 5-year rule, which is something that is extremely important, but for whatever reason, flies way under the radar. But as always, before we get into the crux of the episode, the free advice for the week. Your success in financial freedom will not come from your best investment. Your success in financial freedom will come from your consistent positive actions. Now we've got that free advice out of the way. It is time to get into the most important 5-year Roth IRA rules that go under the radar. Now, just to take it a step back before we get into this, because this is going to be a little bit more of a technical episode than most. It's good to set the foundation with Roth IRA 101. In Roth IRA, Roth individual retirement accounts are popular for their ability to help people pay income tax up front and then enjoy tax-free long-term growth in tax-free withdrawals during retirement. Now, when you add to retirement accounts, it's obviously appealing in the years where you are in a lower tax bracket because you pay the lower tax today, then that money goes tax-free. And then when you're in retirement, in pulling that money out, you otherwise would be in a higher tax bracket at that point. And so you're avoiding that. And another thing on just fact of the matter, when you're in a lower tax bracket, generally you are in your younger working years. And so you've got all of that time to compound that money tax-free. I could make a serious argument that even if you're in a higher tax bracket, Roth contributions could allow you to lock in that current tax rate forever because theoretically taxes keep going up and up and up. And certain experts agree with that. I personally go back and forth. I'm actually going to make an episode down the road on pre-tax and Roth for high income earners. And I'm actually working with a couple people on that episode, so stay tuned on that. But with Roth IRAs, when it comes to the tax-free withdrawals, there are important rules and limits that you've got to understand. And this framework was described in detail in a new analysis that was published by the Qualcomm Group, which is a consulting and accounting firm. So I'm going to be referring to that throughout today's episode. And what the report described, or some of the things the report described, was not all Roth IRA withdrawals are the same. And to take full advantage of your Roth IRA tax savings potentials, you're going to need to follow all of these rules, including the often misunderstood 5-year rule, which is what the purpose of this episode is altogether. And if you don't, you could actually risk facing unnecessary taxes and penalties. So the first thing that you need to know out of the 6 must-known facts, there are 3 types of potential withdrawals when it comes to a Roth IRA. Now, the 5-year rule requires you to satisfy a 5-year holding period before you can make certain Roth IRA withdrawals penalty-free or tax-free. And there is a difference. So the first type of potential withdrawal is contributed principal. So what you've actually put into the account. And that includes all of your annual contributions to the account between now and when you eventually retire. The next type of withdrawal is converted principal, which consists of an amount that if you put money into a traditional IRA or just an IRA, and you convert it to a Roth IRA, whether just a traditional conversion or a backdoor Roth IRA conversion. And then the last type of withdrawal is from your earnings, which is the interest, dividends, capital gains. It's the gains on your contribution, the rate of return. So the second must-know fact that you need to understand, contributed principal is generally available tax-free. This is where it gets a little interesting. So Roth IRA contributions, they're not deductible. And that's not the interesting part. I mean, that one's just pretty obvious. So that means that your income contributed has already been taxed. So the money that you've put in, it's already been taxed. Now, because of that, you can withdraw, this is where it's key, you can withdraw principal from your Roth IRA at any time, tax and penalty free, regardless of your age or how long the funds have been in your Roth IRA. So to say it another way, the 5-year rule does not apply here for your principal contributions. The third thing you need to know, converted principal, it's a different ballgame. So this is where your 5-year rule can bite you in the butt if you're not careful. So with initial contributions, you can withdraw converted principal without owing income tax because you were taxed at that time, the principal. That being said, violating the 5-year rule can trigger the 10% early withdrawal penalty. So the penalty applies to withdrawals pre-59.5, because you got to be 59.5, that don't qualify for an exception. So the 5-year holding period begins January 1 of that tax year you did the conversion. For example, if you converted a traditional IRA into a Roth IRA at any time during 2020, the 5-year period starts January 1, 2020, and it ends December 31st of 2024. So I know that's really subtle, but what you need to know is when you have a traditional contribution, just a regular contribution to your Roth IRA, that can be taken out tax-free and penalty-free pretty much any time. But converted principal from a contribution, that could be tax-free, but there will be a 10% withdrawal penalty on it. So I know it's a little technical. I'm going to let you marinate on it. And when we come back from the commercial break, we're going to get into the last 3 of the 6 must-know facts that you need to know regarding your Roth IRA 5-year rule. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get into number 4 of the 6 must-know facts about your Roth IRA 5-year rule that you need to know, which is each Roth IRA conversion is subject to a separate 5-year holding period. So what does this mean? If you do multiple conversions over the years, you must carefully track each 5-year period to avoid triggering penalties. That's a lot. That can be very, very cumbersome. And the 5-year rule comes into play only if you are otherwise subject to early withdrawal penalties. So that means that if you are 59.5 or you have a penalty exception that applies, which I'm not going to get into because that gets way too technical for this episode. You can withdraw converted principal penalty free, even if the 5-year period hasn't expired, because again, you're over 59 and a half. So because of this, it is possible for you to use conversions to withdraw funds penalty free before 59 and a half. So for example, let's say that you converted an IRA to a Roth IRA at age 40 and you pay the tax at that time. You wait 5 years and then you could withdraw the converted principal of that conversion penalty free at that time. But again, the growth in the earnings, that's still going to have that penalty because you're not 59 and a half. So you'd have the tax penalty plus the 10% penalty on top of that. So just to reiterate, each Roth IRA conversion is subject to a separate holding period. It can get really complex really quick if you're doing these conversions every single year. Number 5, in terms of the must-known facts, earnings are subject to the 5-year rule. So to make tax-free withdrawals on earnings, which are the gains, dividends, interests, etc., 2 requirements have to be met. The first one is the withdrawal must be made after you turn 59 and a half, or if you become disabled, unless you qualify for a specific exemption. The second rule is you must satisfy the 5-year rule. So even if you're 59 and a half, violating the 5-year rule can trigger ordinary income tax on the portion of the distribution that is attributable to earnings. Now, that being said, failure to satisfy the 5-year rule, that won't trigger the early withdrawal penalty if you are otherwise exempt for it, such as age or a specific exemption. Now, specific to earnings, the 5-year period starts on that January 1 of the tax year, which you made your first contribution to any Roth IRA. Now, this doesn't apply to each Roth IRA contribution, nor to each Roth IRA if you have more than one. So very quickly, you're figuring out like Roth IRAs, yes, they're extremely valuable, and there are 5-year limits that you need to be aware of, but it can get really cumbersome really quick unless you are taking detailed notes on this. And the bummer with the IRS, well, there's a lot of bummers with the IRS, but the bummer with the IRS is they're not going to tell you this until you get your notification that you're going to owe XYZ in tax. So you got to take hold of this, or your planner needs to take hold of this. And then last but not least, number 6 on the must-know facts about your Roth IRA 5-year rule. Ordering rules also come into play. So what do I mean by ordering rules? So consequences of violating the 5-year rule, it can be costly. I think we've safely established that during this episode. But there are ordering rules that will help you avoid these mistakes. So under these rules, withdrawals from your Roth IRAs are presumed to first come from principal, then converted principal, and then your earnings. So if your contributions are large enough to cover the amount you wish to withdraw, you're going to avoid the taxes and penalties, even if the 5-year rule hasn't been satisfied for converted principal or earnings. Again, because those initial contributions have been so much. So if you've been maxing out your Roth IRA for, let's just say 35 years, and yeah, there's growth and maybe there's some converted principal, but a lot of it's earnings as well. I mean, unless you're just taking gobs of money out at that time, the odds of you having that tax trigger for the 5-year rule not being met, it's going to be pretty slim because of the ordering of the rules. That being said, if you withdraw the whole Roth IRA, which is it's very rare, but you know, I've heard of stories with that. I mean, I've never had a client do that, but I've heard of stories where a client gets to retirement or a person just gets to retirement and they take the whole Roth IRA and they just cash it out. The ordering, it goes out the window because because at that point you're taking your principal, your converted principal, and your earnings all at once. And so that earnings, you're going to have a penalty. And that's where people go, well, I thought it was all tax-free. It is if you satisfy the 5-year rule. So that does it for today's episode. I know it's a lot more technical. If you have questions, you know where to reach out at this point. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Christopher Paniotu is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.